Welcome to the CLS Market Review for the month of April 2014. I'm your host, Matt Harwell. The S&P 500 gained just under 1% last month, bringing its total return to just over 2.5% for the year. Smaller companies continued their losing streak in April, declining almost 4% for the month, bringing down their year-to-date return to almost negative 3%. Developed international equities outperformed U.S. markets in April, with European equities gaining nearly 2% for the month and up over 4% year-to-date. The 10-year Treasury yield inched down to close at 2.65%, while the bond market posted modest gains for the month of April. With all of this price movement, we turn now to CLS Chief Investment Officer Rusty Vanneman to discuss how this has impacted CLS's portfolios. Rusty.
Thanks, Matt. The markets indeed had some very interesting price movement last month, some of it that was quite positive for CLS portfolios. For more on the markets and CLS positioning, please refer to our monthly commentary found on clsinvest.com. For long-term investors, the biggest news items last month were two important studies. The first came from the annual release of the quantitative analysis of investor behavior that came out from the Boston-based research firm Dalbar. In short, they found that stock market investor returns significantly trail those of the stock market averages, attaining only a bit more than half of the market's overall return. The biggest reason for the substantial underperformance is due to behavioral reasons, not due to information or intellect disadvantages. Investors tend to buy investments after they've already gone up in price, and they tend to sell the underperforming securities. In other words, investors buy high and sell low. They don't do this when they buy groceries and make other purchasing decisions, but they do it with investing. This behavior has a real cost. Over the last 20 years, the S&P 500 had a return of 9.2% per year. The typical equity investor, however, had a return of only 5% per year. This behavior gap is over 4%, and it should be noted that this even grew slightly larger over the last year, even though the stock market had a fairly steady climb higher. How can investors help close this gap and make it easier to reach their goals? One important way to do this is through investment advisors. Good advice is powerful. Advisors help investors create a plan. They help investors save more. They build and maintain balanced, diversified portfolios that are managed with a consistent process. And they help many investors stay the course, especially during times of market stress. Dalbar recommended some additional best practices to avoid money-losing behavior. We think it's solid advice. First, have lower expectations. This has the effect of essentially forcing investors to save more. This is typically clear-cut advice for most investors anyway, but with equity valuations currently higher than average and fixed income interest rates lower than average, both suggesting market returns will be lower than the long-term averages in the years ahead, this has become an even more important consideration. One study has shown that most investors significantly increase their savings after getting investment help. Second, control exposure to risk. At CLS, we strongly believe in this, as our risk budgeting methodology has been doing this for years. An investor can't control market returns, but one can control portfolio risk to a large degree. Third, monitor your risk tolerance. Investors typically measure their risk tolerance, in other words, their financial and emotional capability to take financial risk, when they initially establish their portfolios, and about once a year afterwards. If anything, though, this should be measured more frequently and definitely reviewed during times of market stress. That means not only during bear markets when stocks are down in price, but also in strong bull markets when stocks are racing ahead of their fundamental values. Risk tolerances change over time. Portfolio risk budgets should too. Fourth, Dalbar recommends presenting forecasts in terms of probabilities instead of a single number. At CLS, we're big fans of this idea, and we publish similar data in our latest quarterly market review, which can also be found on clsinvest.com. Instead of showing forecasted returns, though, we show historical returns going back to 1871. There are numerous lessons from this data, including the key points that investors